In the first quarter of fiscal year 2027, the global energy markets collided with a severe and unprecedented macroeconomic shock. The catalyst was physical and immediate: the sudden closure of the Strait of Hormuz. This geographic choke point effectively severed 12 million barrels of Middle Eastern production capacity from the global grid overnight. That physical bottleneck triggered a secondary economic contagion. Global supplies of LPG and naphtha choked, and the cost to charter a vessel out of the region spiked to 10 times the standard freight rate. Looking at this chart of Reliance Industries leading into June and July, we can see how the market priced these dislocations and rising crude premiums into the conglomerate's valuation. The Hormuz closure acted as a physical stress test of global energy infrastructure. It exposed exactly which producers had the logistics to adapt and which were entirely dependent on a single, vulnerable supply line. Yet, when Reliance released its consolidated earnings for that exact same quarter, they reported an EBITDA of over 54,000 crore rupees. Despite the raw material inflation and severe supply chain headwinds, that figure represents a 10% year-over-year growth. That final profit pool breaks down across the company's three foundational pillars: oil to chemicals, retail, and geo. This raises a mechanical question. How does a highly exposed conglomerate expand its margins while its primary raw material supply chain collapses? Understanding this performance requires a deconstruction of how Reliance used legacy agility to fund its aggressive consumer expansion. This dual bar chart compares refinery utilization. While an aggregated average of Asian peers saw their operating capacity drop roughly 20%, Reliance maintained a utilization rate of 97%. To maintain throughput, Reliance pivoted its sourcing strategy, pulling crude volumes from Latin America, the United States, and Africa to replace the lost Middle Eastern barrels. Executing this pivot required an aggressive logistical response. The trading desks heavily chartered available vessels to ensure they could keep running the secondary units and capture the high fuel cracks available in a deficit market. This rerouting carried heavy costs. Securing these alternative shipments meant paying steep official selling premiums and absorbing the exponential spikes in maritime insurance. Reliance's trading agility transformed a geographic liability into a throughput advantage, keeping physical crude flowing when competitors stalled. Simultaneously, the petrochemical segment faced its own feedstock crisis, triggered by a severe shortage of LPG and naphtha. This line chart tracks the violent price action of naphtha. As the Hormuz blockade dragged on, the cost per ton surged past the $1,000 threshold. For Asian competitors who rely exclusively on naphtha to run their ethylene crackers, this price spike caused their chemical margins to collapse. Reliance operates with a specific structural defense. 70% of their ethylene feed is derived from ethane, not naphtha. Ethane prices softened during this period. High oil production in the United States generated abundant associated gas, a supply completely insulated from Middle Eastern geopolitics. To secure and extend this supply line, the company is taking delivery of new very large ethane carriers directly from the U.S. Moving to the consumer business, analyst attention often settles on the retail segment's compressed 7.9% EBITDA margin. Reliance internally funded a deliberate land grab in the quick commerce sector, prioritizing infrastructure scale over immediate margin percentages. This chart shows diverging trend lines. Total retail revenue grew by 12%, even as the EBITDA margin percentage dipped to 7.9%, proving that underlying consumer demand remained strong. The sacrificed margin supports the expansion of dark stores and hyperlocal delivery infrastructure to support platforms like GeoMart and Agio Rush. The capital burn is justified by a single core unit economic metric: successfully transitioning an offline shopper onto the omnichannel platform. The internal data proves the math. An omnichannel customer delivers 2.7 times the wallet share of a strictly offline shopper. Retail's short-term margin compression is a calculated acquisition cost required to lock in long-term customer lifetime value. Looking at the telecom pillar, Jio's massive 5G network build-out is now complete, and those capital expenditures are fully capitalized. While this pushes heavier depreciation costs through the P&L, it shifts the division's strategic focus toward monetization. This stacked bar chart isolates that shift in revenue streams. Baseline connectivity grew at 11%, but digital services surged ahead with a 20% growth rate. High-margin growth is driven primarily by the rapid adoption of fixed wireless access through Geo Airfiber, alongside bundled managed services for enterprise clients. With 285 million users already on the 5G network, Geo possesses a captive distribution funnel to upsell these advanced, higher ARPU services. Geo has matured into an entrenched, high-margin digital ecosystem, having moved past the capital-intensive phase of infrastructure building. The integrated design of the conglomerate becomes clear when looking at the cash flows. The cash-rich oil-to-chemicals business provides the defensive foundation that allows the consumer divisions to play aggressively on offense. That cash flow is also driving the next major capital deployment cycle, the rollout of the new energy gigafactories. The Jamnagar site is scaling into a 20-gigawatt integrated solar PV manufacturing complex, handling everything from raw polysilicon production down to the final module assembly. Running in parallel is an aggressive pivot into AI infrastructure. Reliance is self-funding a 168-megawatt data center build-out in partnership with Meta. These investments interlock. The data center will be powered by Reliance's own green energy assets and managed end-to-end by Geo's intelligence teams. The financial resilience of the legacy businesses directly subsidizes the infrastructure of the next decade without placing undue stress on the corporate balance sheet. The figures from Q1 FY2027 demonstrate the successful navigation of an extreme stress test, providing evidence of structural resilience under actual fire. Returning to this stock chart, it's evident the market mispriced Reliance's agility. Despite severed global supply lines, O2C's structural feedstock advantages kept margins intact, allowing retail to prioritize customer acquisition and Geo to monetize its 5G baseline. Because the core operations remained insulated from the macro shock, the company's future-facing capital expenditures proceeded entirely uninterrupted. Reliance Industries utilizes its integrated conglomerate structure to transform macroeconomic chaos into a competitive moat, absorbing global supply chain shocks while its peers stall.